now tuned into the Money Level Show.
Hello, everyone. Welcome back to the Money Level Show, where we think, act, and prosper. Today, we have the pleasure of sitting with Chris Whalen, the chairman of Whalen Global Advisors, LLC, and an author of multiple books, but most notably his recent book, Inflated: Money, Debt, and the American Dream. How's it going, Chris?
Hey, Daryl. How are you? Thank you for the invitation.
Yes, thank you. Thank you. I've been watching you for a while, and more specifically when the banking crisis of 2023, when we had Silicon Valley Bank go down and multiple banks go down and
Yep, that was an active time, wasn't it?
yeah. And you were very helpful in my understanding of what happened. And so, yeah, I always appreciate that. So recently there were some stress tests done in by the Fed for the banking industry, and just kind of want to get your take there. Like, how healthy is it now? Is it still bad? I mean, some of them are still have these long-term debt instruments that are not yielding in a higher rate environment. I'm assuming.
Mm.
So just want to get your perspective there.
The banking industry generally is overcapitalized. And what I mean is that they don't see enough demand for credit to really justify all the capital that the regulators in Washington have made them raise over the years. So the Trump administration is going to lower capital requirements. Fed Vice Chair Mickey Bowman is leading this effort. And what you're going to see, and you're already seeing, is that banks are going to pay off preferred securities. They're going to call them and redeem them. They're going to get rid of them. So there is a net dearth of duration out there. Duration is another fancy way of saying bonds. There's been big inflows into the bond market this year, despite the fact that stocks have hit new records. But the breadth in the stock market has been shrinking rather dramatically. You got a couple of stocks that account for most of the uptick in the last couple of months. So people, I think, are feeling like they want to have a good amount of their money in relatively safe income producing assets. And I agree with that myself in my portfolio. But, ultimately, I think the stocks are probably going to crawl higher despite all the hand wringing about interest rates. And when we do finally see the Fed cut rates, you're going to have another little mini boom. You're going to be seeing more issuance of debt and equity securities if rates fall. It'll kind of look like the third quarter of 2024. And then we'll do that for a year or two, and we'll probably see a significant reset in home prices in 2028. I published a biography of a fellow named Stan Middleman, who's a longtime friend and client. He's the founder of Freedom Mortgage. And Stan predicted it almost perfectly. He said, eventually the Fed's going to cut rates. We're going to have a lot of business that we're going to do for a while. And then home prices have to come down because they've risen by almost half since 2020, Daryl. People can't take that. Every once in a while, we need to let home prices go down so people can find a deal. My
Hmm.
parents used to do that years ago in Washington. They'd buy a little house, we'd fix it up, I'd live in it for a while, do a lot of the work myself, and then we turn around and sell it. And in DC, the damn house would double in value every 5 years. It was such a strange market. It's not that way now. It has definitely cooled off.
So why 2028 for housing to start to cool off or come down significantly? Why that year?
Because supply will have caught up with demand, number one. You do see new supply entering the market, although it's still pretty pricey. You don't see supply entering in the bottom. If you think the average mortgage today is about $400,000, there's not a whole lot of new supply down there at 250 or $300,000. Those mortgages are actually considered small by the industry, and a lot of investors don't want to own them. And it's hard for home builders to build for that market because of inflation. The cost of building a house is crazy. I'll give you an example. If you built my house today, I have a little bi-level in Briarcliff Manor, New York. Probably cost you $350 a square foot to build that house. That cost maybe $100,000 in 1974 when it was first built. I paid $700,000 for it. So that shows you what the home price inflation has been like over the past 40, 45 years. it's rather dramatic. And I think that that's what really puts pressure on new supply at the bottom of the market. But if you look over the average price, five, $600,000, there's a lot of stuff sitting out there that they can't sell. And so you're starting to see prices come down. There's still a standoff between buyers and sellers in the US home market. But I think that 2028 prediction is just that home sales and home building are long-term markets. So after a period of boom, you're going to have a reset. And the question is, how far down do we go? Do we go back down to 2021 or 2020 levels? That implies a 20-25% price correction. And that means a lot of the mortgages that have been made in the last couple of years, they're all going to be underwater.
Mm,
So think about that. But we haven't had that kind of correction in the United States in more than 3 decades. The Fed just hasn't allowed it.
yeah, yeah. And so the Fed hasn't allowed it. I mean, this kind of screams some form of
Well,
intervention.
Paul Volcker, you know what I mean? Imagine if Jay Powell had pushed mortgage rates up to 9 or 10%. You would have seen home prices come down. We had home mortgages at 8% for a whole week in 2023. That was it. So
Right.
they are afraid of pushing the envelope in terms of forcing a deflation because they don't know when it would end. If
Hmm.
you had something like that happen, you'd have a lot of corporate defaults. You might even see the U.S. Forced into some problems in terms of financing the deficit.
Yeah. And some argue that that's the type of pain we need for
Yeah.
kind of cleanse the system of its
Well, it wakes everybody up for a little while, doesn't it?
yeah,
You
yeah.
know, you get everybody's attention. Um, if you go back to 2018 when Jerome Powell, he had been in office as chairman for less than a year, and they almost ran the ship of state into the ground because they didn't know that shrinking the balance sheet while they were also raising interest rates was going to eventually dry up all the liquidity in the market. You know, I was there. We were trading repo that week, and there was no money. Jamie Dimon, Wells Fargo, they'd all folded their arms and said, "Oh, we're good." This is in like November of 2018, right? So we went a whole month with no liquidity at all in the short-term repo markets. And it was only at the end of the month that the Fed noticed what was going on, and they completely changed policy and went the other way. You remember they had the press conference with Janet Yellen and Ben Bernanke in January of 2019, and then they started selling and buying securities and selling futures in the mortgage market. They pushed the market down even before COVID. This is
Mm,
what people don't understand. The Fed ran scared from early 2019 until March of 20, and then they really put their foot down. So the reason we still have inflation as a problem in this country is because the Fed went too far. Way,
yeah.
way, way too far.
Yeah, for sure. And do you think that the pivot could go too far this time? I mean, Jerome Powell, his term is up next year.
Hmm.
President Trump has been putting pressure on some of the Fed governors and such. He just replaced one. I think he's one of them. He's trying to get out of there, saying that there was some corruption with some housing, and then she's
Yeah,
coming out
mortgage
saying
fraud. Uh-oh.
she's coming out saying she's not going to be bullied or whatnot. And
Yeah.
so, I mean, we could have a totally different looking Fed by this time next year, right?
Yes, and I think that was inevitable. But let me say this, Daryl, when people get nominated and then confirmed by the Senate to be Fed governors, they change.
Hmm.
I remember we write about this in the book when Harry Truman had his great confrontation with Mariner Eccles. And, Eccles told him no. He said, "We are going to retake control over monetary policy." This was after World War II. And after all of that, they had a big confrontation. Eventually, he appoints William McChesney Martin, who worked at the Treasury for Truman, had been head of the Export-Import Bank. You'd think he like Trump, right? You would think he was one of their guys. And he turns out to be the biggest advocate for central bank independence of all. And the longest serving chairman, too, by the way, didn't leave for 20 years. So my point is that no matter who they appoint as chairman, I think the Fed is going to continue to function because, if they let inflation get out of control, we have a big problem. And then institutions like the Fed don't matter anymore. So by managing this process in an astute and I think open way, they can add credibility. And unfortunately, Trump tends to take away from credibility of the United States because he's so bombastic. You know, he loves hyperbole. He
Mhm.
loves having a press release every day. Every
Yeah.
day. He's got to be top of the news. So in that kind of environment, you know, I always tell my clients, take Trump seriously, but don't take him literally. That
Hmm.
you're not going to make money taking him literally.
Yeah. Yeah, for sure. Yeah, I mean you know, there's a lot of writing on the wall, like where I could have made some money, especially like with Liberation Day. I mean, I made some
Oh
money
yeah.
on the bounce back. I went and bought when there was blood in the streets, but I
Good.
was thinking,
I
I
did
said,
the same thing. And I told my people, I said, look, these tariffs are really a distraction. When
hmm
Donald Trump came out with all that, you know, shock and awe, that was a buying opportunity. That's when
yeah,
I went and bought some American Express. And
hmm
I was very happy I did. Nvidia traded off too. That
yeah, it
was a
went down to 80 bucks or
trade.
something like that, right? 85
Yep.
bucks, 90 bucks.
Yep.
Yeah, I made some. I didn't hold long enough, but I did make some profit, which was good. But just thinking about when you get at those types of lows, me as an investor, the question kind of becomes, okay, how long do I want to hold this? Like, is this I kind of gotten out of like the forever hold of specific companies, even if they are solid companies, or even if they're,
Hmm.
like Nvidia is a $5 trillion company. I have some friends there like, hey, we're going to hold this for like 10, 20 years. And it's like, well, who knows what's going to happen in the next, 1 year, 2 years. You can have a huge
Yeah.
drawdown and
Well,
you,
you can't be indifferent. No, I totally agree with you. But my rule of thumb for short-term trading, I'll give you an example. When Fannie Mae and Freddie Mac had traded off because we weren't talking about them anymore earlier this year, I went in and bought some Fannie Mae. I told everybody, and I just kicked it out this week because I saw all of this yah-yah going on with the Fed and interest rates. I was up 25%.
hmm
So my rule of thumb is when you're up over 20% in less than a year, you got to take you got to take the money off the table.
yeah,
Uh, Nvidia, to your point, but I've been in and out of that stock 3 times, and it's another great one. By the way, is Hood. Hood was dead money for what, 3 years? It just
yes,
kind of
yeah,
laid there, and then it
8 bucks,
took
nine
off.
bucks.
Another one is SoFi.
Yeah,
SoFi was dead money for years. And all of a sudden they start getting their act together. They're growing. They still don't make a lot of money, but at that crypto connection and some other aspects of it, equity managers decided that they loved it.
yeah,
Another one, Lending Club, dead money. It was dead money for years. They do a deal with Blackstone. They're selling bonds on their platform that are rated by Fitch, that are guaranteed by Blackstone. Yeah, or I think, excuse me, I think it was Black Rock. I got my
yeah, yeah, yeah. Palantir
platforms
too.
mixed up.
Palantir was
Yeah,
dead money.
Palantir. Oh my God. So, there's a lot of momentum in this market, Daryl. You can't pick and choose some of these things because they are so difficult to get in front of. If I feel like playing the macro trade, I just use the S&P
Hmm.
futures
Yeah.
and the ETFs. That's the most efficient way to do it. But I own banks. I own a lot of bank preferreds that I haven't touched in years. I think I mentioned this before the show. My best winning position is Williams, the pipeline company. It's doubled. So I'm
hmm
going to hang on to that one. It pays a dividend, you
Yeah.
know?
Yeah. Yeah, definitely. What typical kind of yield are you looking at? Are you looking at like the growth of the yield? Or are you looking at more higher yields? So like for me, I got, I'm in some of the REITs like Old Realty and
Hmm.
I bought them when they were selling off was it earlier this year or
Yes.
something like
Well,
that.
that's another opportunistic trade. You want to buy those REITs well below book. So
Hmm
I started loading up on Annaly when it was down at like zero point 0.8, because that's a good company. They're very well managed. It's leveraged, relatively risk-free mortgage-backed securities. They own a little bit of servicing. So pretty straightforward. If you want teens kind of yields, you're going to have to go to a leveraged platform like that. And to
hmm
me, Annaly is one of the best performers in the sector. There are others in that complex. I cover mortgages that have higher yields, but you got to look at them real careful.
Yeah.
REITs is a whole nother world. They're basically a pass-through. They don't accumulate a lot of capital. So you want to try and find a vehicle that's not going to take a lot of risk.
Hmm.
You're really looking at the arbitrage in terms of the yield.
Yeah, and I mostly use like the REITs. Right now, I'm in two of them. I'm in LTC properties. It
Mm-hmm.
focuses on long-term care facilities and such, which
Mm-hmm.
that's going to be a demand for a long time. And then also O Realty, which come at a premium, but I'm also looking to like compound over time as well. And so
Mm-hmm.
that's kind of been my
Yeah.
approach has been like compounding in part of my portfolio or with one of my accounts is really focused on dividends compounding. I do have some
Right.
natural resources where those are cyclical and I'm going to sell them as they appreciate. But then, I have this kind of growth aspect too, where I'm trying to find something that's below book value that if it increases significantly, then I'm going to sell it at a profit.
That's the idea. It's remarkable the disparity in results that you see. You look at Mr. Cooper, which is trading 2 times book. It's a mortgage company, this is not normal. And then you have other established names that are trading at a discount. PennyMac,
Hmm.
incredible. One of the best performers in the industry. Another interesting one, Rhythm. That's a REIT that does mortgages. They own a lender.
Hmm.
You're not typically going to get alpha from a stock like that. It's mostly about income. If you're
Yeah.
looking for alpha, you got to go elsewhere.
Yeah, so the REITs, like when you look at the charts of the REITs, many of them have have got, I mean, since COVID, they got pummeled, many of them. And
That's
so,
right.
when you're looking at some of the charts, you're like, dang, this thing just fell off a cliff. And
Well, that's because the rates were at zero. That's why. People were
yeah.
desperate for yield. Remember,
Hmm.
there were a lot of money market funds that almost went out of business at that point, and the Fed had to come in and issue their own T-bills. That's what we call reverse repurchase agreements, which showed you that the Fed had done too much. They had to come in and mop up the excess liquidity by issuing reverses. But that was also to keep the floor on interest rates off zero. So a lot of money market funds wouldn't just shut down. They didn't have
Hmm.
enough carry to make money. So, at the time, REITs were a godsend. They still had yields up in the low teens. That's why they perform that way. That's not normal, though. If you could do a 10-year chart of the better REITs, Daryl, you'll see where they should have been.
Yeah.
2020 was an anomaly, to put it mildly.
Yeah, for sure. So, I mean, even just on this conversation, like you mentioned, when you're up 25%, taking that profit off the table and such, I mean, that's beating inflation. So I recently did a course for some high school interns at my job,
Hmm.
and it was a financial course, and the biggest thing that I mentioned was like you have to beat inflation, and just we went over some of the numbers of, the lack of savings that Americans have, you know, also the retirement crisis that's on the horizon and such. And so we went through
Hmm.
government debt, all of that, and we talked about just like, okay, what's scarce holds value. We talked about gold. We talked about, as more dollars get printed, then the value of or the price of real goods and services goes up. And so I really was drilling down on inflation. Inflation, you have to beat inflation. So when you're thinking about, some of these equities that are, paying you 6 to 8% or even more than that, or if you appreciate in value by 25%, or in some cases you may appreciate more in value in other equities, I mean, Nvidia's up 100% since
Yeah.
Liberation Day. And so that's beating inflation, and so I do want to speak to inflation because this is part of your book where you talk about inflation. And
Hmm.
so, could you share to like how big is this problem of inflation, and the impacts that it's having on people, and then what's your outlook on inflation moving forward?
Well, inflation colors everything. If you look at the shift in political trends, if you look at what's going on in New York and the mayor's race, the cost of living and the way that inflation has eaten away at people's purchasing power, made housing more expensive, made everything more expensive, right? Cost was the by far and away the overriding issue in the last general election. So you have to look at it that way. Now, why do professional investors, people who run funds and everything else, all have a 20% equity hurdle? That's because of inflation. That basically says that they want to make more than the rate of inflation every year to try and stay ahead. And I think, to me, the fact that you have to have a hurdle that high tells you everything you need to know about the real world of inflation, not the statistical stuff you see in the news and the newspaper, right? But what is really happening to people at the ground level in terms of their cost of living. So I agree with you. You want to generate at least high single digits to low double digits income on your portfolio every year. That's not easy to do. In order to really stay ahead of inflation, you're going to have to take some risk. You're going to have to be willing to trade the market long and short. And I do that to a limited degree with the portfolio I use. I publish my portfolio for my readers so they can see what I'm doing. And when I give them my next update, I'm going to show them that I basically took all the alpha off the table, except for Nvidia. I put a sell order underneath it at $170.
Hmm.
And we'll see what happens with the Fed. I don't think we're really going to get a decision this month or even in September. They may do nothing again. Can you imagine this market if they do nothing? That's going to
Yeah,
be quite amusing.
depressing for folks.
Because the market's anticipating a cut. Mortgage rates have dropped 40 basis points since July.
Hmm.
It's extraordinary.
So typically when you're taking money off the table, like some people may question, okay, well, the dollar's going down in value, so why would you
Yes.
sell the equity? Are you parking it into gold? Like what do you typically do? Are you finding the next opportunity, T-bills? What are you typically doing in that situation whenever you take profits off the table?
I will put it into income initially. So, for example, a lot of the proceeds I took this week, I actually put it into increasing my position in Annaly. And the reason I do that is I like the company, I like their risk management approach. It's still about 13, 14% yield. And to me, that's a good place to be. I also added to a couple of my preferred positions. I bought more City Trups, which is a 9 3/4. It trades at a premium though. It's a $25 preferred. It's around $30 because people love it. They love the cash flow. But unfortunately, a lot of corporate issuers are calling in their debt because they are finding that they don't need it. So you have to look in other areas for income right now. What I often tell people is if you have positions you like, you can use options to generate income with it. I only recommend that people buy or sell, or excuse me, buy puts and calls. Don't be a seller of options if you're not really, really expert in the markets. You want to
Hmm.
quantify your risk. That's why you use puts and calls. But other than that, I mean, it's hard to generate anything in the mid-teens or higher without taking a fair amount of risk and being focused on the market every day. It's not something you can just do and forget about.
Yeah, yeah, for sure. So I do want to transition to part of your book where you talk about wealth concentration, and this has to do with inflation. When we think about real wages,
Mm-hmm.
you know, uh, how much we get paid versus how much the value of the dollar has decreased and the price of real goods and services has increased. And so, obviously, many people are already kind of in on the struggle bus with I mean the statistics about 40% of Americans don't have $400 in emergency expense for an emergency
Yeah.
expense. Retirement, I mentioned that earlier and such. And so this issue of wealth concentration, I think about it in terms of typically at some point there's a reversion to mean. I mean, historically, sometimes you may have a bust, where it wipes out everybody gets, gets impacted in that type of environment. And then, folks can go in and start to accumulate equities very cheap or whatnot. But you also mentioned a point about the financial crisis in Malays where there's like more involvement from the Fed and keeping you know their involvement and how they influence the market and such. And so I don't know, just trying to make sense of all that. Like how do you view wealth concentration and how it's impacting, average Americans, and then also, do you think at some point we get some type of bust, and or do you think that the Fed's continuous involvement will prevent that from actually happening or going through that for a long time?
Well, if you think long term, the first real bust in the modern period was 1929 and then the Great Depression. We saw a total liquidation of private debt markets. By the time we got to the mid 30s, there was no private debt. The
Hmm.
only debt out there was the government and big banks, big corporations. And they took us through the Depression, through World War II. So by the time you get into the 60s and the 70s, that's kind of the dawn of consumer finance, mostly non-banks. Before that, there was nowhere to get a mortgage. Credit availability was non-existent, Daryl. People forget just how strange things were. Even as late as the 1990s, it was not easy for somebody to go out and buy a house and get a mortgage. So what's changed is that we've seen an explosion of the availability of debt. That has tended to feed inflation because you have more people out there chasing that house, chasing that apartment they want to rent, buying a car, doing everything else. And the tendency in the system is pro-inflation. In other words, they will pull tomorrow's sale into the present using monetary policy. They drop interest rates. All of a sudden, people are doing deals that they might not have done for another year or two. They might have had to save money or do something like that. So the whole tendency of the system has been inflation on the one hand, but then in 2008, you had just what you were talking about. You had a bust. You had a lot of people who were broke. You had millions of homes that were out there in foreclosure. So home prices dramatically fell. And they didn't really recover until 2016, 2017, because we started to clean up the mess in terms of busted houses and busted mortgages. And at that point, home prices started to go up again. Do I think we're going to see another bust like that? Yes. I think 2028 rather, we'll probably see a home price correction. It's already happening now in a lot of markets. But if the Fed drops rates, as everybody expects, you'll have a little mini boom next year and in 2027. But by the end of 27, I think it's going to be very obvious that home prices are too high and are going to have to come down. So you may see another buying opportunity in real estate. You already have that in commercial real estate and particularly in multifamily real estate in some of the big cities. The politics in New York, the politics in Chicago are not helping prices for apartment buildings right now. So, there are opportunities out there, but it's kind of cyclical. 2008 was about single family homes. This time around, really since COVID, it's been about commercial real estate and apartments. It was really dramatic. After 2021, the loss rate on multifamily loans held by banks almost immediately went to 100%. You know what the loss rate is on single family homes today? Zero.
Mm,
Because home prices are so high that if somebody gets in trouble, the servicer will just help them sell the house.
yeah.
They'll pay off the debt and they'll give them the balance. That's why default rates are still so low for single family homes. If you look at apartments in New York City, oh my God, it's like death and destruction because of politics. People want to limit rents and everything else. Politics are awful for anything that's inside the city. And
Yeah.
then you look at single family homes in that market, they haven't gone down in price because there's no construction. I am astounded because, historically, New York, Connecticut, Massachusetts were the worst markets in the country for single family homes because of the politics. You couldn't do a foreclosure in New York for years. In fact, you might even lose the lien on the house because the court system in New York is so screwed up when it comes to progressive politics. Fair enough, right? But if you go down south, they were building too much. Florida, the Carolinas, you got stuff that nobody can even sell right now. So you can see that there's a correction coming. It's just a question of when. And I do think there's going to be a lot of opportunities for people who've got dry powder.
Yeah. What do you think about the impacts of immigration enforcement and in home, so like if let's say, I mean, right now people are being removed from the country, and
Hmm.
we don't have to get into like whether that's right or wrong or whatever, but just thinking about, okay, let's say, you know, those folks own homes. Some of those folks own homes, right?
Or
Like,
they build homes.
yeah, yeah, or they build homes. Like, I'm kind of wondering if there's some impacts there.
Well, look, a lot of labor came into this country over the past couple decades in the home building sector. Mexico, Central America, you name it. And, I see it every day in my hometown in Austin, New York. Who's out building houses? Who's out cutting the grass? Who's out learning trades? It's the Latino community. So, to the extent you're sending people home, either voluntarily or through deportation, it's going to, I think, impact home prices. Now, home building right now is in a slump where you don't see the levels of activity we saw during COVID, which was crazy. People trying to buy homes, people trying to build homes, fix homes,
Mhm.
whatever it was. Remember, you couldn't hire anybody for love or money. It was just impossible.
Lowe's and Home Depot stock did good during that time.
Exactly. Exactly. But the point is now things have quieted down. Prices for lumber, prices for other material have come down a little, not nearly as much as they were before. So I think overall it's going to hurt prices because the availability of labor is much constrained. And, Trump is going through the 55 million or so undocumented people that are in the US now. They're going to continue to deport them.
Hmm.
And I think it's got to squeeze markets. Will it hurt the home market itself? No, there's still such a supply constraint, especially in the bottom half of the market. I don't think it'll help. We have too much supply in the top half. Let's put it that way. There's a lot of five, $600,000 homes that are looking for an owner right now. Go down to
Yeah,
Delaware, go down to the Carolinas. Lot
yeah,
of lot of spec building.
yeah, yeah, definitely. Yeah, there's kind of a interesting. I was listening to David Stockman recently speak about the um, he was speaking about the birth rate in America and the birth rate on a decline, and then also the amount of immigrants that are like supplying or that are working some of these jobs, and a lot of it had to do with we don't have like enough people with even within our nation to just take on a lot of this workload, and so now we're
That's
deporting a
right.
lot.
No,
And so,
we should allow immigration. My ancestors from Sicily were no different from the Latinos who are coming to this country today. They
mhm,
were all looking for opportunity. I think there's got to be a legal way to accommodate the demand. Many people want to move to this country because this is still the leading nation in the world in terms of lifestyle and standard of living.
yeah,
There's no question about it. But, the politics are unfortunate. Donald Trump won because of an anti-immigrant agenda. And if you poll people, they still, even the recent immigrants, they don't want to let their cousins in. It's kind of funny. I used to do a lot of work in Mexico. So the one thing you could depend on is if you go to somebody who immigrated to this country legally and say, should we make the illegal immigrants leave? We'd say yes,
yeah, yeah.
because they
That
don't
was
want
kind
the
of interesting.
competition.
Yeah.
But I think look, the U.S. is the only major industrial nation that isn't suffering a precipitous decline in population. If you look at China, you look at Russia, you look at many other major nations, most of Europe, if you take out immigration, they're shrinking. So immigration's a good thing. It was only in the last century and a half that we actually started defining national borders. Prior to 1800, people would just wander around. They didn't ask permission.
Hmm.
They would just go.
Yep, yep. That is true.
My dad's ancestors came to the United States in the 1780s. I'm not sure they got permission to come in, but at least they didn't swim here.
Yeah, yeah, for real. They were like, "Yep, we're coming, we're leaving, we're packing up, we're all going."
Well, they got out before the potato famine, but the British tyranny in Ireland regarding the Catholic population was terrible. You
Yeah,
couldn't pass property on to your children. You were basically a non-person. So the
yeah,
fact that they could immigrate at that time was, a godsend for them. Most Irish immigration actually went to Britain.
Hmm.
Liverpool, Leeds, the great northern cities in Britain.
Yeah, yeah, for sure. Just thinking about um, when we think about, wealth concentration, financial crisis, and these things that you talk about in the book, where do you see things going from here? I mean, obviously, 2028, your prediction is that housing is going to come down for multiple
Hmm.
different reasons. What do you think about the stock market still at all-time highs? The crypto market. Now you have the government wanting to do crypto treasuries, and then Trump has his own coin and everything, and, and so I'm just
Yeah.
like, okay, yeah, the Genius Act signed to boost demand for treasuries, I guess. And so, what's your take on all of that part of the markets?
I don't think the crypto market is going to help the treasury net net. The whole thing about stable coins I see as an extension of financial repression. Because think about it, we go from paper money in the Civil War all the way through the Great Depression. They confiscate all the gold, say you have to use paper money. And then we get to crypto tokens, which at least we can make money speculating on, right? Because the price goes up and down. And then we get to stable coins, where they take our money and invest it in treasuries to earn the yield, and they charge us fees. I mean, this is like a prepaid gift card. So I personally think that, stocks are going to continue to reflect inflation. They're a hedge on inflation. If we see an economic recession or weakness ahead, the stocks will trade off. That's your buying opportunity. But I think you always want to be cognizant of the arbitrage between paper, stocks on the one hand, and real assets like gold on the other. I view crypto as kind of an amusing sideline because if you look at the rest of the world, people play with crypto, especially in Asia, but they invest their money in gold. And they are big buyers of physical gold now. The gold market, for all intents and purposes, has migrated from London to Shanghai. The opening of the Shanghai gold market in 2002 was probably the single most important development in global monetary policy since Bretton Woods. But Americans don't understand this. The allocation to gold in the US is still less than 1% of investing assets. In the rest of the world, it's much higher than that. So, I think we're in a funny phase in the US. We're probably going to have to go through a couple of financial crises to wake everybody up. And then we'll see. But we have to have fiscal reform in the US, otherwise, we're not going to survive.
Yeah. Yeah, what implications do you think the big beautiful bill, has on, I mean, obviously, Doge came in, and, there was a lot of disruption at the beginning of the year.
Yeah, what happened to that Doge?
Yeah,
My
yeah.
God.
I think it failed miserably. I
That
mean,
doggy ran off.
they're still on X. They save about 10 billion here and there, I guess, in future contracts or
Yeah, yeah.
something like
They just tell them to stay out of my housing crib. When they said they had found a couple $1 billion at HUD, I was like, no, no, no. That's a
that.
standby for if a Ginnie Mae issuer fails. You don't want to mess with that.
Yeah, yeah, for sure.
Oh
So,
God.
yeah, I mean, there was a lot of. I thought the goal was noble. As far as like
Yes.
2 trillion, and it's like, okay, yeah, I could
No,
definitely.
listen, pulling the government into the modern age, Daryl, is a good thing. I'll tell you a funny story. I'm sure you haven't heard. AOL decided to finally kill their dial-up service about 2 weeks ago. Would it surprise you to know that Ginnie Mae still used a dial-up for people to certify pools before they issue mortgage-backed securities? I
Oh,
swear to God.
wow, wow, I did not know. I did
We
not know that.
need to put that behind us. The entire federal government does need to be renovated. And there were a lot of Democrats, believe it or not, who were happy to see people going through agencies like Social Security, just find out what's going on,
Hmm.
make sure they're doing what they're supposed to be doing. The Fed, too. The
Yeah,
Fed spends a lot of money that they should not have spent.
yeah,
So I welcome the attention. I don't welcome the hyperbole. If we could just you know, do what the Trump's been doing and not have all the yelling and screaming and misinformation, I think it would be better.
yeah, for sure. Yeah, this like, yeah, put your money where your mouth is, and stick with it.
Yeah.
And let's
Well, go
let's not.
save the money or tariffs. They could probably raise a couple $1 trillion over 10 years with tariffs. So it's not like it's trivial, But if we're borrowing a couple trillion dollars every quarter, which is the result of the big beautiful bill, you had asked me about that. No, we got to get that number down a lot.
Yeah, yeah, for sure. Okay, yeah, that's good to know. So, tell us more about the book. Tell us more about what we can expect when we read this book. What was the motivation behind it? What do you want to communicate to the American people? I'm sure can anyone around the world can read it, but it specifically says the American dream, which that was something that was sold to a lot of people. Even sold to a lot of immigrants. Like, hey, you can live the American dream, right? You can own a property, you can have free market capitalism, you can escape tyranny, or things of that nature. So there's aspects of the American dream that applies to people all around the world.
It does. In terms of imagery, I think it's still quite powerful. What I wanted to do with the book was just tell the financial and monetary history of the United States in a comprehensible way, in a way really anybody could understand, have some fun with it. I think it's important to realize how much impact war has had on the U.S., both World War I and World War II. People often think the gold standard or tariffs caused the Great Depression in the 1930s, but it wasn't. Probably the biggest single driver in that period that really made inflation terrible was the end of World War One. They stopped buying our stuff. The agricultural sector collapsed. And then you had technological innovation, electrification of factories all around the US had an enormous impact. It raised productivity, but it also made people unemployed. And it had a huge impact. You had people moving from the country to the cities for the first time. And they found very expensive housing. Inflation was a very, very important issue 100 years ago in this country. It was probably one of the most important issues in any political contest in any big city during that period. So what I wanted to do with Inflated is explain how did this sleepy agrarian society in the 19th century end up, running the world economy 100 years later. We took the baton from Great Britain and we ran with it. We were the victor in World War II and we kind of reordered the entire world to suit ourselves. But this is changing, and I think the book is meant to really help people understand how we got to where we are today and be able to understand the changes that are going to occur in the future. And there are going to be a lot of changes, Daryl, many of which are not at our choosing. But that's the history of the world, I think.
Yeah, yeah, definitely. Especially when we think about cycles and history doesn't repeat, but it often rhymes.
It often rhymes. That's right.
Yeah, that's definitely important. Well, audience, be sure to go check out the book, Inflated Money, Debt, and the American Dream. Where's it available at Chris?
Oh, book can be bought on Amazon, Barnes and Noble. The audio edition's out, which everybody's been waiting for. People want to listen instead of read, which I
Yeah.
understand.
How many pages?
And you can, hmm?
How many pages?
How many pages? It's about 60,000 words.
Okay.
I cut the original edition down. I added two new chapters. I took the part about Henry Ford, which I subsequently published in my Ford book, Ford Men, out. Henry was one of the chief causations of the Great Depression.
Hmm.
I had always been fascinated by that history of him in 1933, but he was a very strange man.
Yeah.
He was
Yeah.
the biggest cash depositor in the United States in March of 1933.
Mm.
So he caused a lot of problems. But I think, if you just realize that it is our flexibility and our ability to recreate ourselves periodically that really makes the U.S. such an interesting place. That's the American dream. And I look forward to hearing from your listeners if they have any questions.
Yeah, for sure. Where can I reach you?
I publish the Institutional Risk Analyst blog, and I'm active on X and LinkedIn under RC Whalen. I also write a column for National Mortgage News if you work in the housing industry, and I look forward to hearing from you.
All right, sounds good. Well, you all have the information. I'll be sure to link to it in the description below. Be sure to hit the subscribe button if you aren't subscribed. And thank you, Chris, for coming on. Look forward to having you
My
back.
pleasure, Daryl.